So in this video, I want to talk about time series analysis, and a little bit about forecasting. Um, Really and truly, time series analysis and forecasting is a whole branch of mathematics, really, in the area of investing and stocks and all of those things, right? It's a whole big branch. So the intention here is just to introduce you to some ideas and so in uh, time series analysis and a little bit of forecasting, right? Not to, you can't get into any kind of depth because the level you're at and so on, the mathematics that is needed, the background mathematics that is needed is a little heavy. You are now starting out, you have no, uh, you know, good mathematics training or heavy mathematics training that would prepare you for this. Not at least not as yet, right? So let's talk about what is time series. What is a simple definition here? It's just a sequence of data, right? And these can be all kinds of things. It can be the prices of stock. They can be temperature data. They can be sales data. All kinds of things they can be. Depending on what area of business you're into, or not as business, but time series analysis covers anything that has to do with that you can measure over time and analyze. And, we can take that after we have done the analysis. As it mentions here, after we've done some analysis using some heavy mathematics, then we can use that, whatever analysis we have done, to see if we can forecast, we can predict the future. And you know how good we are at predicting the future, right? And we're humans and even mathematicians and all that they have. We have been very poor at doing so, right? What might happen is we may be right in, so many times out of so many times, right? However, when it comes to investment and so on, dealing with stocks and all of that, right? There are a bunch of people who make a living out of something called trading. I'll show you a little bit of it in a moment. Right? You'll see that all you have to do is you just have to be right a few times, right? And if you can write a little more than half of the time, let's say 60% of the time, you can be very, very profitable, right? You don't have to be right all the time. And I'll talk a little about it when I get into it, right? So a simple example here. It's a stock price and it's changing as from the various dates, they're changing every time. Looking at it, their numbers, they seem meaningless to you, right? And that's why there's need for an analysis of the time series so that it will start making sense to you. And that's where your statistics comes in, right? You're being able to, chart this data. You can chart it, right? And you have lots of powerful software out there. Excel is the least of them. Right? You have so many software packages that you can buy and use to, well, there's some free versions also, right? That you can use to analyze data. And then there's some computer programs like, I don't know if you ever hear about R, Python, so many other programs out there you can actually use to, and those are free, right? Like R is a free program you can use to write a little bit of code, and you will take this data and chart it for you and do all kinds of things for it, right? Chart mean graph, right? Graph it for you, showing a little graph what it will look like over time, right? So we'll get there. I think I have a video, I'll stick in a video, Excel video, where you see somebody taking the data and charting it quickly so that you can get an idea what it looks like. And we'll use some analysis. We're going to do some analysis that will kind of see if they can smooth out the data and certain things. Come to that just now. So these are things you will see in time series data. You're going to see trend. You're going to see seasonality. You're going to see cyclicity. You're going to see irregularity. What are these things? What are these things? Trend, seasonality, cyclicity, irregularity. You see all of these things, and you have to be able to, deal with them, right? What do they tell you as to what decision you should make, and how can you use them to forecast the future, predict the future, playing God now, right? So let's see, trend. So what this is really, it's an increase or decrease in the time series over a period of time, right? And it must have some amount of persistence, right? Can't jump to conclusion quick that, oh, this is a trend, right? So let me see if I can. And I'll have a little video to summarize all of these inserted somewhere just now, right? So yeah, so oh, my pen is working. So sometimes you might see a time series and let's say they're talking about population growth over the years, so you see population I go like this and come down a little, go back, so come up, go back, so go back, go back. So what you're seeing? You're seeing an upward trend, right? Upward trend, right? That's simply what trend is. I mean, if you are into trading and so on, stocks and all of that, we're here to say trend is your friend. I'll show you in just a moment. I did a bit of trading on a particular platform. I'll show you why I say trend is your friend. Oh, it's take off all these because it'll show up on the other. Then they talk about seasonality, and this is telling you, okay, there's some kind of pattern popping up, right? Pattern kind of up and down fluctuations in the short term. Notice that due to such seasonal factors. And they give you a good example. Ice cream sales, right? So during the summer, so you might be plotting maybe sales data, and as time go by, certain hot months, you get let's say, let's just say, there's a certain month or two, right? Now they talk about summer, right? So ice cream sales might be floundering around a little, right? And then during the summer months now, summer, it kind of spike and go up there, Then it go on, and then another year, you see it again during the summer months, right? It's like this is again, and it gone up again. So you're seeing that there's some seasonal factor involved. The place hot, that's what we buy more ice cream, right? That's because seasonality, right? Seasonality. And you can see there are other things, like the prevalence of cold and flu, right? You get those during the rainy season. So in Guyana here, you got what? December, January, you got May, June, you might have a jump in how many people got flu and how many people got cold. Seasonality, right? Hope you get that. So you see that a lot in time series data. Then you have cyclicity, or there's some kind of cycle going on, right? There's some kind of cycle. So maybe to give another example there, you're probably collecting economic growth, right? Growth of the economic growth in a particular country over many, many years. And you see what they say, 5 years of economic growth, right? So goes up, goes up, goes up, goes up, goes up, and then um, followed by 2 years of economic um, recession. Then you get another 7 years. So you get another 7 years, and then it come down back by a year, and then, right? So you're seeing more trend as well as a cycle. So this is like a cycle. This is another cycle, and you would expect now that there's going to be another cycle soon, right? So if you subtract the trend, you're seeing the cycle. Then a couple of years, right? Few years of growth, then a little decline. Couple of years of growth, then a little decline. That's what cyclicity is about. And then lastly, that's what you call irregularity, right? And this refers to some variations that very unpredictable. You see spikes in the data, right? So maybe you are talking about that population. Oh no, it's not. Okay, let's talk about that population thing. Population growing and growing and growing and growing. And then guess what? Maybe there's a disease, right? Like COVID, and then you see what happens. You get a dip, right? You got a dip, there's a dip. Then it start to go up back, start to go up back, And if you want to know, well, this thing was growing nicely here, it's growing there. What happened here? And then they find out, they say, you know what, there was some kind of epidemic, pandemic, or whatever you call it, you kill out a lot of people in the country, and you have that little irregularity, right? So all of that you see in the data. And you have to be able to, know when to ignore something, when to expect something, what does it tell you, And when you're making investment decisions and so, right? And you have to consider all these things, right? You put all your money in something and bam, COVID hit, right? COVID hit and all your investment go down, right? And that's why I tell you when you get into the world of investing, you learn, don't invest all the money that you have. Never do that. Sometimes don't invest your own money, invest other people's money, right? And never invest in one thing because that one thing can go down. You have to invest in several things, and maybe if you invest it in 5 different things, 3 of them fail, only 2 make it. That's the other thing. Welcome to the world of investments, right?
Understanding time series analysis. This video introduces the main ideas of time series analysis. It is part of the At My Pace time series app for iPad and iPhone and online course. As in all statistical analysis, time series data is collected from a real-life thing that we are interested in. The data is analysed using a computer to give graphic and numeric output. The output of the analysis tells us more about the real-life condition. It can be used to make informed predictions of future values. A time series is a set of numerical measurements of the same entity taken at equally spaced intervals over time. Time series data can be collected yearly, quarterly, monthly, weekly, daily, or even hourly. Here are some examples of time series. Average monthly temperature, annual profit for a company, daily petrol price at the pump, hourly electricity consumption in the home, daily takings at a Chinese takeaways, quarterly house sales. Time series data has 4 aspects of behaviour: trend, seasonality, cycles, and unexplained variation. There can also be irregularities or outliers in the data which can be related back to real-world occurrences. Trend is the overall long-term direction of the series. Economic series usually go up, except when they don't. Some series have no discernible trend. Seasonality occurs when there is repeated behaviour in the data which occurs at regular intervals. Seasonality is related to seasonal natural or human behaviour. Cycles occur when a series follows an up and down pattern that is not seasonal. The cycle can be of varying length, which makes them more difficult to detect than seasonality. In all data, there is random variation. Some time series will be very regular, with little random variation, while others may consist of not much else. Sometimes there are strange dips or jumps in a series. These can be due to a one-off event, such as an ash cloud disrupting air travel, or an anticipated change in the rate of sales tax. There are many computer packages that make it very easy to do the mechanics of time series analysis.
Yeah. Then there are some situations where, okay, we don't need to use time series analysis. You know, maybe there's no variation in data. What are you analyzing, right? There's no need for you to analyze anything and try to model the data. Nothing of that you don't need. This is another case where, you know, maybe there's already a known function that can describe the data. What are you doing analyzing it now? You already know how it's behaving, right? So there's no need for that. And this is just, as I said, I'm just scratching the surface, right? Because we gotta go get into talking about stationality and, oh my God, those things are the data. I'm not getting into that right now, right? What I want to move to from here is we're going to talk about in this class here, for this course, just two things that we're going to use to do some analysis and possibly predict, right? Make some future predictions about the data. And we're going to talk about something called moving average. And then we're going to use something called regression, right? Regression analysis, right? So when it comes to moving average, this is an example here. So you have some sales data and you want to say, well, all right, what is the average for these 3 months? And you can use that 3 months, the average of it, to predict the next month, right? If the 3 months you had, 129, 124, 128, you find the average of those, we have 128. You can see here, right? You can see here, 128, 1333. You can say that, that's a good prediction as to what we should expect in April, right? And well, I'll tell you what, if you were to go on YouTube and so you watch more videos on moving averages, and so you'll see they'll talk about centering this, like this 120, they want you to put it in the middle here and that sort of thing, right? Some people are going to put it for April, right, as the predicted value for April. And then they do something called centering, right? And if the data can't be centered, because let's say you have 4 months you're dealing with one time, and you can't center it, then you'll have to do some extra calculation to center it. And so I am not getting into that mathematics here, right? As a matter of fact, this is just my thing as well. Moving averages are a very bad approach to making prediction, right? It's a very bad approach to make prediction. You always, very often, it's off, right? What we're going to use it for, right? And that's why it doesn't matter where we put it, if we put it here, in the middle of these 3 months, or whether we use it to estimate April, right? What will happen in April. Okay, before I go to talk about what it's useful for, I want to talk about the moving average. So you take this tree and you get this average, and you say, well, you know what, April, you think you're going to get that. When April value comes in, April, right? Whatever it is, right? Let's say it's 125, right? Because very often it's not going to be your average that you calculate. Now you're going to take the next 3 months. That's February, March, April. Right? You're going to take those 3 months now create an average and forget the centering thing. You put that for May. Say that, you know what, we expect this to be May's sales, right? Whatever it is. So that's the idea there behind a moving average. I'm also going to insert a video of a guy actually doing it by hand, right? He's gonna do it by hand on a piece of paper. But then I'll show you, I'll have another video inserted here where somebody is going to do it on Excel, right? So there's going to be a video where a person is going to do it in Excel very fast. And that's if you have Excel in your computer, you can try it too, right? So nobody does anything by hand in the business world anymore, right? So there's a way you can actually use Excel, and as I told you, there's so many other programs out there. Some of them are commercial types. Some of them you can actually write one line, two line code, and it will do this for you. But back to the point I'm making. Moving averages are very bad at predicting future values, right? Especially when there's seasonality in the data. You're gonna see this when you go to the video, and so you see that, okay, let's say you have some data and you got some serious seasonality, you know. Okay, let me not do that. Let me do one with a little bit of trend, right? So I wish I have some more space. So let's say you have some trending data, right? What? And you are to do the moving average, and the moving average is somewhere here, you know. And it's not going to be a nice straight line, you know. So go like that. So let me say the average here for this value. Look where it is and look where that value is, right? Look where this one is and look where that one is. Look where this is and look where that is. It's way off. Let's say you take one here. Look where the value is. Look where this one is. Look where that one is. So the moving average sometimes is very far from the actual data, and therefore the exact using it as a prediction tool in terms of exact prediction is a bad idea. What it's very good for, and I'll show you how valuable it is, right? Because with it now, you can actually predict trend. And as I said, trend is your friend, right? Trend is your friend. So what I'm going to do, I'm going to put in that video of how to do it by hand, moving average, how to calculate it. I think it's two videos. One of them, the guy is doing it by hand, right? And then the next one, the guy is using another person. I just took these off YouTube, right? Why you want to do these things with my hand and create a new video and write out everything on the screen when it's all out there already? So we'll insert it here somehow, and you're gonna get it. But I want to show you before I go away to regression analysis. I want to show you a little video of me doing a bit of trading on a certain trading platform, right? So I'll pause the video here. I want to open that video because I videoed myself doing it. Pause. Good. So here I am on a trading platform, right? So let me just explain, because it's, you know, to just throw this at you just like that. You know, it can be overwhelming, right? So on these trading platforms, you can actually, you know, kind of make an entry as to whether you believe the stock is going to go up or down, and so, right? And you see mark higher here. I don't know if you're seeing that higher. Let me see if I can do some annotating too. Right? So let me annotate. You see higher, lower, right? And this here is a binary platform, meaning you just have to guess right? Or make an educated guess whether the thing is going to go up or down. And I'm not dealing with a stock. I'm dealing with the ratio of how euro is changing against the Japanese, what is it, the Japanese dollar or yen or what they call it, right? I forgot what the money is, right? The euro against the Japanese yen, right? And they have all the different ones. They got euro, USD. That's one of the most, they call it the most traded pair, right? They got all the other things then. Good. So remember I was telling you about moving average. If you look on the screen, you will see a red line. Oh, besides all of these little things here is what they call Japanese candlesticks, right? Japanese candlesticks. And they have different ways. I don't want to get into that now. You know, the video is going to end up too long. So these are called Japanese candlesticks. And you know, they have, this thing is fully computerized. So they're indicators you put onto this chart, right? Or this white line, this is telling you where the price is at right now. You see here, watch it, there. That's where the price is. So they draw a line right across. Don't worry about that one. I'm not talking, oh, I think I would confuse you. They got red candlesticks and they got green candlesticks. What that means, the green is when the price, the ratio of euro to Japanese goes up, right? And the red one is when the ratio comes down, right? So it's like, you know, Guyana money, let me say you're talking about US Guyana dollars, right? So US is, let's say, 200 over 1, right? So if Guyana money for some reason increases in value, this ratio is going to go down. If US money goes up in value, the ratio is going to go up, right? So up is green, down is red, right? But this is Euro Japanese, right? I hope I'm not losing you. Good. So I'm talking about this red line and this green line, right? This red line is, I think, 50 moving average, simple moving average. They call it the simple moving average. This green line is, I think it's the 15, I can't remember what it was, 15 moving average, simple moving average. I set it. You get to set it, right? And this 50 moving average will tell me the long-term trend. Remember I said moving average helps you with trend, right? So you see the red here, it tells you, oh, the trend is up, right? Green is also going up, so oh, the trend is up. So the green will tell you, okay, the 50 moving average will tell you the long-term trend. The green one is a 15 moving average, right? So when you say 50, I mean they took the price, right? That the average price for the last 50 candles, and they come up with a value, an average. 15 moving average now. Took 15 candles and give you an average, right? And that's what they plot here. Now, the 15 moving average will tell you the short-term trend, while the 50 will tell you the long-term trend. And there's a strategy in trading, right? I don't like what's going on here, right? For those of you who are into trading, and so you know, this, you stay away from this sideways market, right? You stay away from the sideways market. Even here, it kind of go up, right? It crosses, and whenever you cross, when the short term, right, the green crosses the red, it's an indication that it will go up. But do you notice that it came down back below, right? So if you had made a trade and the thing come back below, you would have lost. And I told you about these things that you can suffer loss. But you notice it bounced back and went up here, right? It bounced back and went up. And that should tell you that, okay, if the long term is going up and the short term is going up, well, it's a good time to choose that or say the trade is higher, that it will go up and you will make money. Look here. When the short term crosses the long term and comes down, the thing went right down. You see? So what I'm going to do for the rest of the video, I'll erase all this just now. I'll show you something is going to happen here. I'm watching it, right? And I will see whether this green is going to cross over this red. And if it does, I'm going to make a trade for you to see, right? And I will do some analysis. I can't remember if it's this is the pair I use or the Euro or the US, but you're going to see it in just a moment. And you will see what I do, how I make use of these two simple moving average to make some money, and you'll be shocked, right? You'll be shocked. Prepare to be amazed. Maybe give me some time to erase all of this. I know. Good. So I'm going to start the video, right? The video myself doing this trade, right? And don't be impatient. Watch. Good. So I'm looking, as I said, I'm looking for something to happen because it looks like, oh, there's a red on this. Yeah. This look like something is going to happen now between these two moving averages, right? The red and the green, right? So you see, I'm getting ready to make a trade. I want to put $1,000, right? I want to give it more time too. You know, I want to give it a little time. So I'm watching to see if that green will cross the red and go up, right? Because right now the green is below the red. So and the pair, Euro Japanese, that trade pair, is actually like it's indecisive as to what should happen, right? So let's see what happens. And this thing, this is a patience game. This is, as I said, it's chance. You know, you can go wrong. You can make prediction that is wrong. You can lose money. You can gain money. That's the name of the game, right? So I'm waiting. I'm patient. I'm watching what's going on. Bear with me. Bear with me. So notice they're offering a 90% profit, right? So if you were to invest $1,000, they're going to give you 900 and it's funny, 902.78. I don't know where that came from. It's supposed to be 900, but you know these things. I will tell you there are always hidden charges and hidden this and that. Good. So I'm noticing that the candles are closing above the red. So anytime now that green is going to cross the red, right? It's going to cross the red. It seems so. I'm expecting it. So because these candles are actually most of them are closing above the red line. The short-term trend it seems that it's going to change, right? And that green is going to cross the red. I have to fast forward because where it crosses. Oh, okay. Look at this here. I just want to, I switch the pair. I switch the Euro US dollars. And you can see the crossing. Watch here. When the green crossed the red, you see how far it went up? Whenever that happens, there's a lot of money to be made. When you see this sideways movement, stay away from it. Look here again. Look here again. The green cross the red. You see the big increase? You see that? Right? So you want to make use of that. But let me continue. I want to go to the point where I make the trade. Right? I think I took a picture or something here. Okay, I'm back to the Euro Japanese, right? So for some reason, it's not crossing. Green is not crossing the red. I'll fast forward a little to see what happens. Good. So you see it's on the verge of crossing. The green is lingering there, and I'm getting ready to, you know. Good. Let me fast forward this video. Good. You see the cross? Do you see the cross? I took a trade. It's a bad timing though, because I should have waited for it to come down back, right? And then take it, but it's cross. You see it crossing here? The green cross the red. So the short term cross the red, which means that this thing expect to go up, right? So I actually invested $1,000 US, right? Good. I take another trade here because it's coming down, right? I take another trade, another $1,000. I will take another one here because I put about 3,000 here, 4,000 in fact, and I'll show you why. I'd have to hedge those two above. I call it hedging. So when it goes back there, I'll take a trade down to negate that bad position that I took, right? And I will try also, I should annotate here to show you. I try to negate what is going on here, right? You see, I put a put or a lower or a higher here, and I will do the same here to kind of negate this one, right? Because this is the good position. These positions here, these 3 or 4 that I put here are the good ones. So when this shoots up, I'll take it again here. Look, you see that? So what I'm doing there, I'm negating this one here. You know this? There's a green and red, and there's a green and red. Those are all negated. However, these $4,000 that I put here, I am saying that the price will close above this here. Notice as of now, I will get a profit of 3,000. Okay, gone to 5,000 now, right? So you will see where that will close. So I'm counting on the price ending above these green lines here, above it. All right. And let's see what happens. And you notice how irregularities can very well mess you up. You see it's coming back down. I can very well lose that if it's 6,000 US I placed just now, right? But right now I am in the gain. Okay, 5,000, 3,000, and good. Last 30 seconds now. If you don't have a good heart, you're going to give up, right? So okay, 5,000. I'm in the gain. Notice gone to 3,000. I have 14 seconds remaining, right? 14 seconds remaining. 7, 6, 4, 3, 2, 1, done. And what they're telling me. So my profit is $3,418.33. See that? How did I get that? Because I made use of trend moving average, right? See that? And that's the world of trading, right? That's the world of trading. I could very well have lost that entire $6,000, right? That's $1.2 million. But in this case, I gained on how much minutes? Just a few minutes, right? And a trader's life, for the day they take 10 trades, right? They might lose sometimes as much as 4 or 5 of them, right? And they might win, or make a profit in about 5, maybe 6. They got to be really good traders, right? And moving average can help you to predict the trend. I don't care about the exact value. Notice what you are interested in is where is it going? What is the trend? Is it going up? Is it going down? And you saw here how a 50 moving average and a 15 moving average tells you the trend, right? So that's a little lesson. I wouldn't reveal the platform. I can't tell you certain details. You all are kids. This is for big people, and this is for, before you take your parents' money and do stupidness with it. All right, so I'll pause. I'll pause the video here and I have to get back to the lecture. Okay, so back to ORT, right? As I said, I'll insert 2 little videos as to how you can calculate moving averages by hand, and then I'll do one with take one from YouTube again to show you how they do it in Excel, right? And sometimes you watch some videos and you'll argue, man, sir, how this one do it different from that. You don't worry about that, right? This thing, as I said, is you're just getting introduced to the thing, right? You follow what I show you, right? Good. So you see that little bit there on trading. I'm showing you how you can trade, right, online. People do it all the time. People make a living out of it and all of that, but it's very, very risky business. Bottom line, though, what I showed you that for is to show you how figuring out the trend using moving averages, right, is very powerful, very powerful. You are not interested in the exact value. You are just interested in the trend. Trend is your friend when it comes to investments.
Let us look at an example of demand forecasting using simple moving average method. The demand for an item is observed for 15 months and has been recorded as below. So for month 1, the demand is 280. Month 2, the demand is 288. Month 3, demand is 266, and so on. Now we are being asked to calculate 3 monthly and 4 monthly moving averages for this item. Also, we have to find out the forecast for the 16th month with 3 monthly and 4 monthly moving average. Now for simple moving average, we know that the forecast is equal to the sum of last n demands divided by n. So in our case, first we'll find the 3 monthly moving average. What this means is that we will take the average of the last 3 months of actual demand, and that will become the forecast for the 4th month. So here, even though we have been given the actual demand for all the 15 months, let us first find out the 3 monthly moving average for month number 4. So what we will assume is that we at this point do not know what is the actual demand going to be for the 4th month, but we know the actual demand for the first 3 months. So what we'll do is we'll forecast the demand for the 4th month by taking the simple moving average of the first 3 months. So let me pull my calculator. So the average will be 280 plus 288 plus 266 divided by 3, because n is 3 in this case, which is 278. So 278 is the forecast for the fourth month. Now, while 278 is the forecast for the fourth month, when the fourth month is passed, we realize that the actual demand for this item for the fourth month was 295. Now we need to forecast what will be the demand for the fifth month. So in this case, what we'll do is, since we are taking 3 monthly moving average, we will take the average of the last 3 months. So for the fourth month, what we did is we took the average of the first 3 months. Now for the fifth month to forecast, what we'll do is we'll take the average of the last 3 months, which is this. Similarly, when we have to forecast for the sixth month, we'll drop the oldest demand and replace it with the latest demand. So for the sixth month, we'll take the last 3 periods, which will be these 3 months. So now let's calculate the forecast for the fifth month. So for the fifth month, we'll take 288 plus 266 plus 295 divided by 3, which is 283. So this is 283. So 283 is the forecast for the fifth month, but the actual sales for the fifth month turns out to be 302. Now we have to find out the forecast for the sixth month. So we'll take the actuals for month number 3, 4 and 5. Now once we take the actuals for these 3 months and take an average, we get 287.7. And the actuals after the month has completed is 310. Now based on this, let's find out the forecast for the seventh month. So we'll have to take the average of the last 3 months, which will be 295, 302 and 310. So this number will be 302.3. Similarly, we can calculate the 3 monthly moving average for all the remaining months. So let's do that. So here I have calculated the 3 monthly moving average for all the 15 months. Now we also have to find out the forecast for the 16th month using each of these methods. So let's find it out for the 16th month. So for 16th month, we'll take the average of the last 3 months, which will be 310, 308 and 320. And the average turns out to be 312.7. Now the next we have to do is find out the forecast using the 4 monthly moving average. So here, instead of 3 months, we'll take 4 months to find out the forecast for the next month. Now in order to find out the 4 monthly moving average, we have to take the average of the last 4 months in order to find the forecast for the fifth month. Now the first 4 months are month 1, 2, 3, 4. So we have to use these demands for the first 4 months to find out the forecast for the fifth month. So let me pull my calculator here. So 280 plus 288 plus 266 plus 295 divided by 4, because we have 4 months. So the answer is 282.25. So this is the forecast for the fifth month. So for the fifth month, the forecast we found is 282.25. Now we started from the 5th month because that is the first month for which we have the demand for the last 4 months. And since we have to find out the 4 monthly moving average, we need to have at least 4 months worth of data. So at the end of the 4th month, you would forecast for the 5th month, and you found out that the forecast is 282.25. Now, once the actual month is passed, the actual demand turns out to be 302. So now you are forecasting for the 6th month using 4 monthly moving average. So now you have to take the average of the last 4 months. So we will be taking the average of 288, 266, 295 and 302 in order to find the forecast for the 6th month. So the forecast for the 6th month turns out to be 287.75. Similarly, we can find out the forecast for the next month. We'll have to take the average of these 4 months. So the forecast turns out to be 293.25. Similarly, we can find out the forecast for the remaining months. So let's do that. So these are the forecast figures for months 5 through 15. Now let's find out the forecast for the 16th month. So we'll have to take the average of the last 4 months. So the average turns out to be 317.5. So as you can note the difference based on the 3 monthly moving average, the forecast for 16th month turned out to be 312.7, while using the 4 monthly moving average, the forecast for the 16th month turns out to be 317.5. So this is how you can find out the simple moving average using 3 monthly and 4 monthly moving averages.
In this video, I'm going to show you how to quickly calculate simple moving average for a data. Hey there everyone, welcome to Technisha, where you can find tips and tutorials on productivity tools. If you are new here, don't forget to subscribe to the channel and smash the bell icon to stay updated. A moving average can smooth out the noise from random outliers and emphasize on the long-term trends of a data. This can be really useful for data analysis. Let's see how we can do this in Microsoft Excel. Here is the data of vaccine doses administered in a country for a period of 2 months. Let's try and chart this data. So I've selected the complete data set, and then I go to the insert menu and pick this chart. Here we can see the data of the doses administered per day, but there are a lot of ups and downs and it's difficult to make out a clear trend. Let's try and calculate a moving average for this data. Since this is a time series interpretation where there are both weekdays and weekends, it may be beneficial for us to do a 7-day moving average. So let's go to column D to calculate a 7-day moving average. Let me just name it. To calculate the 7-day simple moving average for a date, we need to average the data of the past 7 days. So we can start on this data set only from the 8th. So on this cell, we need to average the previous 7 days data for the doses administered. So let's go to cell D11 and type in the formula equal to average of, let's pick from cell 4 to cell 10, which is 7 dates, and just press enter. Now this is the data which is calculating the average for the previous 7 days. If we just double click here at the bottom right corner, we are going to fill the formula for the complete data set. So now if you select for the 9th, the dates are going to be from 2nd to 8th. Similarly for 10th, the data is going to be from 3rd to 9th, and so on and so forth. Now let's try and chart the 7-day moving average along with our doses administered. Let me just delete this chart. Now let's select the data again. Remember, I can select the data quickly by putting Control Shift and the right arrow and the bottom arrow. And let's go to Insert, pick a chart, and let me pick this chart now. Let's put this down. Let me just thicken the line here so that we can see it more clearly. So I right click out here and click on Format Data Series and just go to the color column here, and in the width, let's put it as 5 points. There, we can now clearly see the 7-day moving average, and it is relatively easier to make out what the long-term trend is. Let's say that now we wanted to make it a 3-day moving average. All we need to do is to go to the 4th day here and type in the formula equal to average of the previous 3 days data and press enter, and just copy this formula all the way down. Now you can look at the 3-day moving average. Depends on your needs, a moving average can be really useful for data analysis. I hope that this tutorial was of use to you. If you liked it, please subscribe to my channel. Till next time, ciao.
Good. Another approach that is used, and this, to be honest, is it's a little bit of statistics and so involved, right? So we use what we call regression analysis, right? And regression, basically, you are trying to take all the data you have and you're looking for a relationship. And I should put in there, it's linear regression we're talking about. You're trying to take data, and what you're trying to do is see if you can, with trend, with moving averages, you are doing that too. You're trying to smooth out the data and see if you can, instead of having that up and down data, you're trying to smooth it out, right? And that's what the moving average does. Similarly, with regression, you're trying to represent the data with a straight line and use it for prediction. You're trying to see, okay, so you have data, and just draw something here. Draw something. Right. So you have, okay, you have some data, and it's, it's going up. Good. You're trying, there's a good similarity along in high school. You did something called line of best fit. You're trying to see if you can get a line of best fit, right? That would represent this data. You can now predict, okay, if you're given a value here, right? You would predict, what will be here. Of course, you can go beyond the data. You can project this line, right? You can project the line and see what's going to happen here. You're going to forecast, right? That's what you're trying to do, forecast what's going to happen in the future, right? So you're trying to get a line of best fit, right? So that's what that is all about. So they give you some data here. What is this? This is passengers, who are going out by sea, right? For the quarters of 3 years, right? First quarter, second quarter, third quarter, fourth quarter, and so on, right? By the millions, of course. Right? So this got to be very old data. Some people traveling by sea. All right. Let's not criticize the people data. Good. So what we want to do, we want to model this data with a regression line, And if you have to do it by hand, this is what's going to happen, right? So you want a regression line in this form. Do you notice here? Look here. You see the talk about something here, y equal a plus bx. And I don't know if you all know the form y equal, remember mx plus c, remember that thing? So the C corresponds to the A and the M corresponds to the B. You want some line, right? They're going to model this data. Down here is C, and the gradient of this line is B, right? That's what they want. How are you going to do it? Well, there are some statistics behind it, right? And I can't get into that in this course, right? You have to just take the formulas I give you, and that's it, right? So you have to calculate. Notice what they want. They're telling you that B, right, in that formula there, y equal a plus bx, the gradient then of this line of best fit is given by, what's that, n, the sum of xy minus the sum of x times the sum of y all over n times the sum of x squared minus the sum of x all squared, right? And this is not the only form of the formula. In some textbooks, they'll give you something else, right? So notice what they did. Okay, so when you sum up xy, you get, let me see if I can find in a column. Yeah. So in the data, you get x, this is the time period, right? First quarter, second quarter, third, fourth. The second year, the first quarter is going to be 5 and so on, right? The number of passengers going out is this in millions. So in the formula, they seem to need an xy, so you have to take this x multiplied by that y. The formula also needs an x squared. You square all the x's here, you put it there, right? And good. So we're going to look at this trend business a little later on, right? Don't worry about that. Good. So we're going for we want to find A and B, right? So B is given by this formula here. Notice, okay, n is 12. The sum of xy is 418.3 minus the sum of x is 78 and the sum of y is 68.6 all over n times the sum of x squared, which is 650, minus sum of x all squared, which is 78 squared, right? You put all of that, you do the arithmetic, and you end up with B is 0.17. And the gradient does actually reveal how steep the line is. And that could also tell you how strong is the trend. Again, if you were to go on YouTube and look at regression, and so they normally have y equal a plus bx, and they introduce an error term and so to tell you, well, how strong, how good is your trend line, right? Your regression line. We are not going to deal with this, right? You all don't have the statistics training for that, right? In a few years, you may, right? You may. Good. So now that we got our B, we need to get A too, right? We need to get A. So A is given by this formula. Sum of y over n minus b times the sum of x over n. You do that, and you get A being 3.94. So your regression line now is going to be this. T equal 3.94 plus 0.17x. So in other words, all you got to do is put in your x value, whichever quarter you're dealing with, first quarter, the 9th quarter, the 12th quarter, you put that in there. And you substitute and work it out, and that should tell you the predicted value, T, right, of the regression. And then you can match it up, right? You could match it up and see whether they are close or they are far. And as I told you, it's also a bad predictor, right? It's also a bad predictor, right? However, just like moving average, you don't care about an exact prediction. You just want to know, where is the trend going? Is it going up? Is it going down? How strong is it? Right? How strong? Is it a strong trend up? A strong trend down? Right? That's what you are interested in. Right? Good. So as I said, this is just a nice little introduction. What I will do, I will insert after this, the end of this video here. I'll not the end of it, but I'll insert in this video somebody doing this calculation by hand, right? And you see how tedious it is. And then we'll have somebody doing it on Excel, right? Where they quickly punch in some commands, and it spits out the regression, right? And well, you'll see how easy it is when you have the tools, the computer tools, right? So that's our nice little introduction there to time series analysis and forecasting, right? As I said, we are not very good. Humans are not very good with all the mathematics and computer technology we have. We are not good. The analysis, we do all kinds of analysis, but when it comes to forecasting or predicting the future of stuff, right, where data is going, we're very poor. We're very poor, right? As I said, if you can be 60% correct, right, you can be a very rich person, right? Especially if you're into trading and so on, as I showed you in that little clip, right? I do have some notes on the subject, but I think the notes is going to kind of confound you some more. I'll decide whether I'll share it with you or not, right? Good. So that's that for time series analysis.
Let us look at an example of forecasting using the linear regression analysis. Maxus Sales Corporation is in the business of selling laptops. They realized the advantages of forecasting very early in their business. They also realized that in order to perform effective forecast, they need to keep track of their current and past sales numbers. Currently, they are in the process of forecasting their sales numbers for each quarter of the coming year. In order to do this, they have pulled up their sales numbers for the last 12 quarters. These numbers have been given to us in this table. So for each quarter, we have been given the sales figures. So for the first quarter, their sales were 600. Now this is all in terms of units. For the second quarter, their sales were 1550 units, third quarter 1500 units, and so on. Use the least squares method to find forecast for the next 4 quarters. So we have to find the forecast for quarter number 13, 14, 15 and 16. Also, find out the standard error of the estimate. Now in linear regression analysis, there are 2 types of variables. First one is the dependent variable and second is the independent variable. So in our case, time, which is expressed in terms of quarters, is the independent variable, while sales is the dependent variable. So as it clearly is understood here, the number of quarters is not dependent on the sales, but the sales figures are varying by the number of quarters. So the dependent variable is the one that we want to forecast, because we want to find out the forecast for quarters 13, 14, 15, 16. in terms of sales units. In linear regression analysis, the relationship between the variables is assumed to be a straight line. Now the equation of a straight line is generally noted as y is equal to mx plus c, where c is the constant and also the y-intercept, and m is the slope of the straight line. In linear regression analysis, it is commonly denoted as y is equal to a plus bx. Here y is equal to the dependent variable for which we are trying to solve. A is equal to the y-intercept, B is the slope, and x is the independent variable, which in this case is time. So basically a is nothing but c in this case, because a is the y-intercept, and in our normal equation of a straight line, c is the y-intercept, and b is nothing but the slope of the line, and x and y remain as it is. So basically, if we plot the sales figures for the data that has been given to us, then the graph will look something like this. Let's say time is on the x-axis, because x-axis is the independent variable, which is time, and y-axis is the dependent variable, so this will be sales. Now I'm not plotting this to scale, but the points, if we try to plot on this graph, will look something, let's say, like this. So this is nothing but the sales data. Now the least squares method is used to determine the line that can be drawn using these points, such that the sum of the squares of the vertical distances between each data point and its corresponding data point on the line is minimized. So let's say we draw a line here. Let's say this is the line. So this is the regression line. Now corresponding to a value on the x-axis, we will have a corresponding point on this regression line in relation to this sales data. So let's say this is y, and here we will have y dash. So this distance is known as the deviation. And we have to draw this line in a way that the sum of the squares of the vertical distance between each data point which in this case is represented as y, and its corresponding data point on the line is minimized. So basically, if you calculate this distance and then square each of these and then add the squares of these distances, then that should be minimized. Then we'll say that the regression line is a good fit. So basically, in other terms, what we want to minimize is y1 minus y1 dash square plus y2 minus y2 dash square plus so on till y12 minus y12 dash square. In this case, I'm taking 12 because we have 12 quarters. So once we get this line which is the best fit based on the data points that has been given to us, then if we extend this line to the future quarters, then we can get the value of sales corresponding to a time period. So if we draw this in a graph to scale, then using this technique we can then find out the sales numbers for the future quarters. We can also find out the numbers for the future quarters by using a formula method. So using the formula, basically we have to find out the values of A and B. And once we have the values of A and B, then if we put the value of X, which is the quarter number, then we will get the corresponding value of Y, which is the sales for that particular quarter. Now A can be found out by using the formula. A is equal to Y bar minus Bx bar, and B is equal to sigma x y minus n x bar y bar divided by sigma x square minus n x bar square, where A is the y-intercept, B is the slope of the line, Y bar is the arithmetic mean of all y's, X bar is the arithmetic mean of all x's, X is the x-axis values of each data point, Y is the y-axis values of each data point, and n is the number of data points. So here basically for A, what we have done is we have brought bx on the other side, so it becomes y minus bx. Now since we have multiple values of x and y, we are considering the mean values of x and y, that's why x bar and y bar. So a is derived from here, but a can be derived only if b is known, and b is equal to sigma xy minus n x bar y bar divided by sigma x square minus n into x bar square. Now one easy way to remember this is basically if you remember the numerator, sigma x into y minus n x bar y bar. In order to arrive at the denominator, replace y's with x. So basically what this becomes is x multiplied by x, which becomes x square. So minus n multiplied by x bar into x bar. So x bar into x bar becomes x bar square. So denominator becomes sigma x square minus n x bar square. So let's proceed to find out these values. So here I have noted down the values of x and y, which in our case x is time and y is the sales. Now first we'll try to find out the value of b. So in order to find the value of b, we have to find out the values of x multiplied by y for each of these quarters, and then we have to add them up. So let's first find out x multiplied by y. So 600 multiplied by 1 is 600. 1550 multiplied by 2 is 3100. 1500 multiplied by 3 is 4500. 1500 multiplied by 4 is 6000, and so on. So let me calculate all these remaining values. So these are all the values of x multiplied by y, and we need to find out the sum of all these values. So let me do the total. So the total is 268,200. Now next we have to find out the multiplication of n, x bar and y bar. Now x bar is nothing but the average of all the values of x, and the average will be the sum of the values of x divided by n, which is the number of values. And y bar is similarly the sum of all values of y divided by n. So let me find out the sum of all the x's and the y's. So the sum of all x's is 78. So this becomes 78 divided by n, which is 12. So this is equal to 6.5. Sum of all y's is 33,350 divided by n, which is 12. So this becomes 2779.17. So now we know the sum of the multiplication of x and y. We know the values of x bar, y bar. We also need to find the sum of the values of x square. So we have x, but we don't have x square. So let's find out the values of x square and then add them up. So x square, 1 square is 1, 2 square is 4, 3 square is 9, 4 square is 16, 5 square is 25, and so on. Let me put the values here. So the total is 650. So now we have all the values that we need to calculate b. So let's proceed and calculate b. So b is equal to sum of x, y, which is this. So 268,200 minus n, which is 12, multiplied by x bar, which is 6.5, multiplied by y bar, which is 2779.17, divided by sum of x square. So this is x square, sum is 650, minus n, which is 12, multiplied by x bar square. X bar is 6.5, so 6.5 square. So let me pull my calculator here. 12 multiplied by 6.5 multiplied by 2779.17, enter. So this is 268200 minus this value here, so this becomes 216,775.26 divided by 650 minus, so 6.5 square multiplied by 12, that is 507. So this is equal to 268,200 minus 216,775.26. So this is 51424.74 divided by 650 minus 507, which is 143. So this is equal to, divide by 143, so 359.6. So this is the value of B. Now we can plug in this value into this equation to find the value of A. So let's do that. So A is equal to y bar minus bx bar. Y bar is 2779.17 minus B, which is 359.6, multiplied by x bar, which is 6.5. So this is equal to, let me pull the calculator here. So 359.6 multiplied by 6.5 minus, and add this to 2779.17. So the value is 441.77. So this is equal to 441.77. So this is the value of A. So at this point we have the values of both A and B, so we can come up with the equation of the regression line. So let us plug these numbers into that equation. So the equation of the regression line is y is equal to A plus bx. So plugging in the values of A and B in this equation, so y is equal to 441.77 plus 359.6x. Now, as per the example, we have to find the value of sales for the 13th, 14th, 15th and 16th quarter. So in place of x, we will put the values of 13, 14, 15 and 16, and we can find out the corresponding values of y. So let us do that. So y for the 13th quarter is equal to 441.77 plus 359.6 multiplied by 13. So this is equal to 5116.57. Similarly, y for 14 is equal to 441.77 plus 359.6 multiplied by 14, and this is equal to 5476.17. Y for 15 is equal to 441.77 plus 359.6 multiplied by 15, and this is equal to 5835.77, and y for 16 is equal to 441.77 plus 359.6 multiplied by 16, and this is equal to 6195.37. So these are the sales figures for the 13th, 14th, 15th and 16th quarter. Now in the next part of this video, we will find out the standard error of the estimate to evaluate how good this regression line was.
Regression method of forecasting using Microsoft Excel. In this method, basically you run the regression analysis to predict the demand. So the period is used as a X variable and demand is used as a Y variable to basically find the forecast. So I'm gonna just type Y and X like this. So you have to be in data tabs. If you are in the data tab, then you will see this data analysis tool pack. Now if you're just using this first time, you will not see that. So I'll show you how to bring that. So you can right click on the ribbon, customize ribbon, and then click on add-ins, go Excel add-ins, and then you have to check that box says data analysis tool pack. There is another way you can bring it. Go to file and then options, same thing, add-ins, Excel add-ins, click go, and then check that box says data analysis tool pack. If you do that, you will see this data analysis tool pack there, and then select regression, select these values, Y values, select the X values, and then my data has label, so you'll have to check that box says label and then hit OK. So this will produce the regression analysis. Now here you have the slope and the intercept. So we have used 15 period. As you can see, this data has 15 period. If we want to predict for the period 16, simply we can do the slope times the X value, which is 16 plus the intercept. So this will be the prediction for period 16. This is the exact same prediction that we have done in linear trend forecasting. In this case, it's the exact same procedure. However, regression will provide some additional statistics where you can see how good is the prediction is. For example, these two R square and multiple R, they provide the how good or how weak or strong your prediction is. So in this case, the multiple R basically is the correlation between the demand. So the correlation between Y and predicted Y. The Y was demand, predicted Y was the forecast. So the basically the correlation between the demand and the forecast. As you can see here, 40% is considered a weak correlation, and then R square, which is the percent of variation. The percent of variation explained by the percent of variation in Y, in this case demand or forecast, variation in Y explained by the X variable. In this case, the X variable is simply the time period that we have used. So again, this is very poor. 14% is considered really poor when it comes to predicting the forecast based on the time period. Generally, anything over 80% is considered strong, between 60 to 80 moderately good, 40 to 60 is okay, less than 40 is not considered good prediction.